Now, what shall we do? We have got to do something, not for now. I mean, now is a recession for 2 years. Everybody is going to be quiet. No prime in the next 2 years. I mean, just a recession ongoing, a big mess. But in 3 years from now, I bet everything you want is going to start all over again. People have understood, actually, that they can do crazy things. Heads they win, tails the government pays. So how do we do to avoid that next? And you have to clarify goals. And in the first step, I mean, why everybody says there hasn't been the correct financial regulation. We need a new financial regulation. But there's no point doing that if we don't say what the financial regulation is about. We don't regulate for the pleasure of regulating. Regulation is often stifles initiative. It has some primes. The reason why we want to regulate those things are specific, and we have to think about those. Otherwise, we should not regulate. So we have to clarify goals. And of course, we don't have to throw the baby with the bathwater. I'm a very strong proponent of having deep financial regulation reforms, but not any financial regulation reform, of course. And the danger, as usual in those things, is that the politicians will put pressure, because the public opinion is interested in that, into reforming into the wrong direction. So I'm going to offer you a number of proposals. And the first thing I'm going to offer you 5 proposals for today, and there are others that we could discuss. The first thing is just come from the fact, what is prudential regulation about? Prudential regulation is a regulation of banks, insurance companies, pension funds, broker-dealers. Okay? Now, the standard view about this is that prudential regulation is a microeconomic phenomenon, and is basically based on a given institution. You ask yourself, you and I have the money in the bank, for example. Let's take a bank. It could be an insurance company. We have our money there, and if the bank behaves poorly, gambles or whatever, our money is at stake and we may lose it. So basically, the government there, according to this approach, is basically protecting us, protecting the depositors, insurance policy holders or pension fund customers, because we don't have time, and it will be incredibly inefficient to spend our every evening checking the balance sheet and off-balance sheet activities of our banks. We don't have the information, we don't have the time, we don't have the competency, and it will be crazy that zillions of people do that. So we are represented by the government in the banking commission, the regulators, the supervisors in this particular activity. And that's a standard conception, the standard design of policy is that it's really about protecting. And basically Basel I and Basel II are about this. Okay? And if you look at, say, my 94 book on prudential regulation with Mathias de Watripon, almost all of the book is on that. And that there are a few things about systemic risk, and we discussed, but at the time, that was the right thing to focus on. Now, prudential regulation and policy intervention are no longer about that. It's just a completely wrong picture. It's about preventing systemic risk. Domino effect. If I let Lehman Brothers go, what's going to happen down the road in the financial system? Somebody else may go bankrupt, and then somebody else will go bankrupt, and so on and so forth. And I'm going to freeze the liquidity. Since nobody knows who is exposed, I'm going to freeze the liquidity and make financial markets really very bad. Now, I'm going to argue this is in big part due to mutual exposures that you get in OTC markets, over-the-counter markets, which are markets where we trade bilaterally contracts which are not standard. Okay? That only actually a few people in the world understand. And I will argue that this particular motivation has taken center stage in the design of public policy. And that's really pretty clear. And why are we rescuing all those investment banks? Why are we rescuing AIG? Why are we going to rescue an hedge fund tomorrow? It's not because we want to protect small depositors or none. The reason why we are doing that is that we are worried that if they fail, there will be a big problem with the financial markets. And those big problems will come from the domino effect linked with mutual exposures. So I already said that those institutions have their cake and eat it too. And there, I can tell you, and everybody who has talked to regulators, probably some of you in the room, or Martin Elwig and others, will tell you, if you go see a regulator, they will tell you right away that they just are unable to know what the banks they supervise, to what extent they are exposed. What's the exposure to Lehman Brothers? What's your exposure to this and that? Direct and indirect. They have no clue. They don't have the information. And even if they had the information, detailed information of every contract, they have to think about the correlation. They have to think about 200 covenants per contract, which are incredibly complicated and have all kinds of indexations. It's just a nightmare. So basically, we are regulating banks and insurance companies, and we don't know what they are doing. Okay? Now, my own view is that we should protect the regulated sphere. I'm in favor of regulation. I still want to regulate and actually regulate more carefully the banks and insurance companies and the pension funds, but protect those banks against the default of non-regulated players. Because as long as you don't have that, then you'll be forced to rescue entities which are not regulated, are making a huge amount of money by taking gambles basically using a put on the government. So I will be in favor of using capital adequacy requirements for banks, insurance companies, in order to induce them to trade standardized products. Fine, you want insurance against the euro-dollar rate. This is a very standardized product. Trade that. We know what it is, and we can net the exposures and so on. We know how to do it. You can do exchange. You can use exchanges. You can use exchanges in which you basically have a central player who is calling margins, so it's basically asking for collateral along the way. So you know roughly what the exposure is. In general, the exposure of A with respect to B is relatively small if you have an exchange, because there are margin calls, and when you are not able to meet those margin calls, you are out. Okay? And there is some kind of mutualization of the losses. Now, if you compare, how many of you have heard about Amaranth? No? Huge hedge fund went bankrupt 3 years ago. Nobody has heard about it. There's a good reason for that, is that nothing happened. No impact on the economy. There was no impact on the economy because Amaranth failed by speculating a lot on gas contracts. They bet in the wrong direction on gas. But they were trading on exchanges. They disappeared, and that's it. No problem. Look at what happened with Lehman. And look at what would have happened if you had let AIG go. AIG sold a huge amount of protection, insurance contract to all kinds of banks, and so on. What would have happened if you had let AIG go? Huge mess. But Lehman and AIG were trading in OTC markets, bilateral markets, where nobody has any clue about where the exposures are. Amaranth was trading in exchanges. So that's the first proposal. We should encourage trading of centralized products. We should encourage trading on exchanges. And we can use, I'm not saying we should prohibit OTC market, no. But as usual, as an economist, I want to have the right price. And the right price is the capital requirement you put in front of each activity. The other thing, the second thing that I want to propose is to redesign prudential rules. And this is very technical, and I don't have the full answer, obviously. And that's something we all have to work on. We have to work on with the banking supervisors. My own view, and this is a view which is controversial, but my own view is to keep fair value accounting. It has a lot of flaws, but at least it has some truth in it. If you lose money, you're forced to recognize it. And that has incentive properties exposed that basically prevents institutions from gambling for resurrection. And ex ante, it basically deters because you know that you'll be able to downsize, you'll be forced to downsize if you have losses. So fair value accounting I will keep, and I recognize it has many flaws. And my own view is actually some view that, I had in the mid-90s, Martin Helwig had in the mid-90s and so on, but was very unpopular. I remember I sat once at the BIS 20th anniversary with central bankers all around and said, why don't we have pro-cyclical, I don't know if it's pro-cyclical or counter-cyclical capital adequacy requirements. So basically say, during booms, you have to have a bigger buffer. Your asset value is going to fall during recessions, and it's very important that you keep a buffer for that point of time. Some variant of it has been done, by the way, in Spain. It's called dynamic provisioning. So the Spanish supervisor asked for more, bigger buffer, some provisions during the good times. And that was very fortunate because otherwise Spain would be in deep, deep trouble. It's already in deep trouble like this, but just imagine that, those banks will they don't practice dynamic provisioning. So I was sitting at this 20th anniversary of the Basel, of the BIS, the Bank of International Settlements, and said, why don't we have pro-cyclical capital adequacy requirements? And there is a central banker, I'm not going to name, said, this matter is not going to be discussed. And it was not discussed a second. This was a complete taboo. And I understand actually some of the arguments, which are mainly political economy arguments, which if you are allowed to lower capital adequacy requirements because of a recession, for example, or increase them during a boom, then you are subject to lots of lobbying by the banking industry and others. Right, so we have to make those cyclical, again, I don't know how to call them pro-cyclical or counter-cyclical capital adequacy requirements. We have to make them more mechanical, I guess. This is a very difficult topic. There's a lot of research to be done, by the way, both policy research and theoretical research. There are lots of other issues. How do you regulate liquidity? Every country has some kind of bad liquidity regulation. They're all different. How do you do that? Reforms to solvency regulation, compensation of managers and traders. There are lots of issues there that we have to tackle. Third proposal, I'll stop at 5, don't worry. Third proposal, the bad guys, the rating agencies. I mean, they're not only the bad guys. I mean, it's unfair to say you put all the blame on them. I would say we have to regulate them. We have to regulate them because they themselves are regulators. They have become regulators. They are private companies, but they have become regulators because they are auxiliaries of regulation. So, and just to tell you why, what happens with insurance companies, pension funds, and since Basel II banks, is that you are allowed the capital you need to put in front of a loan depends on the quality of the loan. If it's a high-quality loan, low probability of default, you have to put less capital. Okay? You have to put less capital, which means that your rate of return on equity is going to be much higher. So actually, the big game for all those financial institutions is to have as little capital as possible. Okay? Now, fine. If you have a loan which is not very risky, you should not be putting much capital. So it's kind of logical in a sense. So if you buy if you hold a AAA security on your asset side, then you don't need much capital on the liability side. Okay? And what else if it's a safe or risky loan? The rating agencies. And the rating agencies, for that reason and others, I said it's a very concentrated industry, are incredibly profitable because you have to go to them in order to get this AAA rating, which is wonderful after that, because then you can sell to all the banks and pension funds and insurance companies who are very eager to get those AAA ratings. So if you take firms which have been doing well, like Exxon and Microsoft, that's nothing compared to rating agencies. So I think we should have a creation of an international oversight agency, some kind of regulator, eliminate conflicts of interest, make sure that the compensation they get is not increased when they give AAA ratings. We could have performance measurement. It's not easy to organize, but after all, we should have some kind of centralized record in which you look at what Moody's and Standard & Poor's have done and see ex post whether their predictions were right. Why not? Of course, we know it's difficult. It's just like, how many patients, died with his doctor. You know that this kind of measurement can give rise to perverse incentives, but I still think it would be useful just to see how accurate their measurements were. And one thing that they just refuse to do is to normalize their rating. So if you buy a AAA security which comes from some kind of municipality bond, so a municipal bond in the US, if it's rated AAA, the probability of default is actually very small. Actually, the rating agencies have been doing a good job on that. Same thing, a corporate bond, if it's AAA, probability of default maybe 1%, 2%. I mean, it's not big, it's pretty good. If you buy subprime loans and it's rated AAA, forget about it. And it's just like a big mess. Now, especially if you think in terms of regulation, the normal thing will be to say a AAA is a AAA. AAA represents probability of default and a loss given default. So when I'm buying a AAA, in a sense, I don't care whether it's subprime or municipal bond or corporate bond. I'm buying a return, and a return is a probability of default and a loss given default. Now, there should not be a factor of 1 to 10 in terms of that, for example, in terms of default, or 1 to 40. That doesn't. Now, the industry is still resisting not only normalization, but even putting AAA SF, which is AAA structured finance. Even that they don't want to do, which is just putting, say, it comes from structured finance. This is bad. I think they are going to accept. Maybe they have already accepted now because there's a lot of pressure, but I don't think that's sufficient. They should be accountable. If they say AAA, it's AAA, whatever it is. Okay? Fourth debate is on securitization, and I'm not sure where I completely stand on this issue. Let me say, there are lots of calls saying you should be keeping a minimal share of the loans you issue on your balance sheet. Remember, for subprime, it used to be 40%. Now it's 80%. And now it's nothing because there is no securitization anymore. But in 2006 to 2007, it was 80%. And of course, you should not be allowed. It's a standard thing. You should not be allowed to undo the stakes through a derivative contract. Sometimes CEOs, they get stock options. And what they go and they do, and they go to an investment bank and they sell it short. So basically, they cover themselves against the loss. Okay? So, or the fact that they won't gain money. So basically, they insure themselves, but then there is no incentive left. So if you undo the incentive scheme by signing a derivative contract on the side with somebody else, then basically it's like fraud. It's fraud because your incentive scheme is meant to have you work and behave correctly, and then you write a contract on the side which basically undoes the incentives. And that happens for CEOs. that happens actually. Same thing when you securitize. Imagine that the bank says, look, you can trust me, I'm keeping 60% on my balance sheet. So you see, I'm accountable, I'm keeping part of it. That really proves that those are good loans. And then basically writes a contract and resells the 60%. Well, discreetly, of course, on the side without telling anyone. That's fraud. But you could have a regulation which says you have to keep 60% on your books. But this regulation will not make sense, okay? Because imagine, for example, you lend 10 euros to the government, okay? Why should you keep it on your books? You could securitize it. Actually, it's called a treasury bond, okay? It doesn't make any sense to keep it on a book because you can transfer it. In principle, the German government is safe. And there is no big issue about no incentive to monitor the German government. And it's a bond. And nowadays, we never know because if the deficits keep going the way they are going, a number of countries might have some trouble. But still, in some industry, the minimum fraction should be 0%. In some other industries, it should be 60%. What do I know? Something I feel much more secure about is the following. One of the things that happens is that sometimes when you securitize, there is no recourse. So basically, you sell that stuff, and if there are bad news, well, you have no liability. You don't have to put money back into it. Actually, many of those contracts are like this. However, the banks have their name on the door. So if you remember well, in 2007, before Bear Stearns went bankrupt, there were two of its funds which had a lot of trouble. And those funds were sold, basically. I mean, there was no issue about Bear Stearns being liable for them. However, Bear Stearns basically bailed them out. So put a lot of money in there because it has his name on the door. Now, why is that bad? Well, when a bank does that, basically by bailing out something it has issued, some structure vehicle that it has issued, then it's basically a liability, but it's a liability in front of which there is no capital. So there is no capital for reputation risk, okay? And that's basically, it's like cheating in a sense. Because, again, that's taxpayer money which is at stake, or depositor money if there is no deposit insurance, which is at stake, and there is no capital in front. So, but of course we understand, from Spence, for those of you who have studied Spencean signaling, we know that there is an incentive to say, look, I'm a good bank, you can trust me. I'm going to rescue and bail out this entity I have issued, even so I'm not obliged to. Standard signaling argument. And this is dissipative signaling, as Spence has shown. And my view is that sales are sales. If they are final, they are final. And otherwise, there should be a capital charge in front. So basically, the supervisor should prohibit this dissipative signaling. You should not be able, as a bank, to bail out entities that you have issued if you have no liabilities. Or you allow yourself that, but then there should be a capital charge in front because there is a risk. I mean, it's just as simple as that. We economists think there should be a price for everything, and the price should reflect the cost here, the cost to the taxpayer. Okay? So that's a simple regulation that will prevent that. Of course, the financial institutions won't be happy about it because until now they had no capital in front. Last thing before I conclude, the international regulatory infrastructure. We are in deep trouble. A week ago, I co-organized, actually Jean Tirole and the Bank of France organized, and I helped a little bit, a conference in Paris and on the crisis. one more conference on the crisis, but it was very interesting. And one of the highlights of the moment, Martin was there, and Matthias de Wattrepo and many other people were there. But one of the highlights were Peter Pratt, who is the head of the Belgian National Bank. And he was telling us about all the stories about the bailout of Fortis and Dexia with the Dutch and the Luxembourg and France. It was very, very interesting. Very close culture, Benelux and so on. And when you see, it's exactly what economic theory will predict. I cannot talk about this here. Actually, he didn't want to talk about some things in private, but it's actually very instructive about what happened. We now have cross-border groups. At the very least, there are European groups. Actually, Deutsche Bank. I mean, all those entities actually worldwide. So that, how do you deal with those? They are not German banks anymore. Think about UBS. Okay, think about Dutch banks or English banks. Those are cross-border groups. And the public policies, they all have some kind of spillover effects on other countries. Fiscal choices, monetary policy, deposit insurance policies, bailouts, bankruptcy procedures. They all have externalities. So for example, just to give you a simple example, if a Swiss bank is about to go bankrupt and the Swiss government contemplates whether to rescue that bank, now this Swiss bank is actually not in Swiss. I mean, the customers are all over the place. So then if you bail it out, of course, you avoid the cost of deposit insurance for various, otherwise the deposit insurance will have to repay the depositor in each country. And, there is a clear externality there. Monetary policy also, as I will emphasize tomorrow morning, monetary policy is another way to bail out. I already said that today, which is you lower the interest rate in order to bail out the institutions. But you bail out these institutions which are going to have an impact in other countries. And you can sign memoranda of understanding, MOUs. In the end, you are quite sure that at the last moment, each country is going to be protectionist or nationalist. And ring fencing by US authorities, which try to basically bring back all the liquidity to the US and leave an empty shell in other countries, is just an example of that. But we don't have to point the finger at the US because in Europe we will do the same. So I think it's much better to anticipate this and not let's have some negotiation when the banks go burst. Okay. Another issue which is raised by cross-border groups is visibility, because you have mutual exposure all over the world. You have kind of risk all over the world. Of course, the regulators and the supervisors, they share information. In good times, it's easy to share information. Gentleman agreement, I give you the information, you give me the information, who cares? The bank is not going bankrupt. In bad times, that's a different matter because there is money at stake there. And I don't believe that, based on other industries I know, I don't believe that just having supervisors share information is going to be sufficient. In my view, I will, at the very least, and probably it's insufficient, create a European supervisor. Of course, we can worry about it being a big bureaucracy and all the problems with the European Union and blah, blah, blah. It should be, in my view, independent. Located at the ECB might be nice, because the ECB is independent, and on top of that, there are also issues of coordination between monetary policy and prudential supervision. We could discuss that. I think this is something which has to be refined. Last topic I want to mention is the issue of sovereign debt, which, as I mentioned many times today, is a worrisome issue. Of course, it's my generation giving giving this foreign debt, just like we give the CO2 prime to your generation, but I think we are paying for the lack of discipline, which is a good policy is to have a substantial deficit in recession and a surplus in booms. Of course, we never do that because we never have surpluses in booms. In general, I mean, I'm taking on an average, we don't have surpluses in boom. We just still stay at 3% of deficit of Maastricht, for example, in Europe. And of course, what this means is that when there is a big recession like now, we are getting to levels of deficit and public debt which are way too high. And I hope I'm wrong. I don't have any numbers, and I'm not sure, but I hope this is not going to create big issues with sovereign debt. You know, my guess is that they're not going to default on sovereign debt, but you know, if I had to think about what's going to happen in the US, I don't know if Bernanke will remain at the Fed, but you know, you could not imagine that the US government is going to default on its bonds. I mean, that's not going, treasury bonds. It's not going to happen. But don't forget they are nominal, and then you can think about the next stage. Okay? So let me conclude, and I've been too long, I apologize. Let me conclude with a few remarks. Being someone who works in the economics of information and game theory, I'm happy to report, I must be the only happy person in these times of recession, that actually it's a textbook case of, for the economics of information. It's not a very nice stance of mine because the times are not that good for most people. Loan issuance, there is two-way asymmetric information. There is standard thing that borrowers have more information, but the lenders also have more information about the risk than the lenders. Securitization, the issuers securitize, and the other, the buyers don't know the value of the securitized loan. Protection selling, I didn't talk about monolines and so on, but all kinds of protection selling on OTC markets against default of banks and so on. Ratings. The ratings had poor information about the securitized product. The market had poor information about what the rating agencies were doing. Mutual exposure and the fact that nobody, even the regulators, could see what was going on. And regulation, and of course there is a prime of asymmetric information between you and me and the supervisors. I mean, where they're doing their job. And that's always an issue. We don't have the information to judge, quite judge whether they're doing their job. It's a textbook case of massive regulatory failure. And again, you know, I want to emphasize we have to be very careful about promoting regulation, but it's pretty clear that the regulation didn't do its job. Now, is that hindsight bias? Yes, of course, it's easier to say ex post. And certainly as to the magnitude of the phenomenon, I personally, I don't know about other people, and you always have people who bet on one side, one way or the other, but personally, I hadn't quite understood how big it will be. Certainly not hindsight bias in terms of identification of hazards. They're all there. You take the textbooks of the 70s, you know, the articles of the 70s until now in the economics of information. You could just anticipate much of the phenomena. Again, maybe not the magnitude, but many of the phenomena that we have seen, you could basically anticipate them. So in that sense, I wish there had been more application of theory there. Political agenda, hard to say. I think there is a short-term windows of opportunity. Obama was just elected and obviously is more interested in international agreements and regulation than the previous administration. And people are worried. So you know, in terms of public opinion, there's actually some concern about this. And I think we should take advantage of that. I'm still pessimistic, but you know, to force the US to, because the rating agencies are American, of course, you know, and that's part of the difficulty. I mean, that's our fault. In Europe, we haven't been able to generate rating agencies. I mean, We didn't have to do industrial policy, but we have to ask ourselves, why is that they're all American? And we have to start thinking about the international regulatory infrastructure. You know, do we want a European supervisor, for example, and do we want a European treasury? I didn't mention the US have many supervisors, too many supervisors, but they have at least one treasury. Europe, we have national supervisors, and we have no treasury. You know, when you talk about bailouts, it creates a problem. When Ben Bernanke wants to bail out an institution, he goes and sees the secretary, and then, you know, just Paulson at the time just says, I want to rescue and let's negotiate a deal. How do you do that in Europe? Basel II, in the medium term, will have to be reconsidered. I argue that we should think more about prudential regulation, macro-prudential regulation. If we don't want systemic risk to be the main driver of policies, and I think it should not be, but it is, we need to engage in macro-prudential regulation and make sure that the average leverage, especially short-term leverage in the economy, is not too large, because otherwise you'll always have to engage in monetary bailouts. You have to deal with mutual exposure, and I offer some ideas about this. You have to deal with securitization, possibly, and so on. I'm not going to conceal the fact that there's a trade-off between better risk measurement and effective regulatory control. From Basel I to Basel II, we moved toward better risk measurement, but poorer regulatory control. So with Basel I, which is bad regulation, but it has the benefit of being very mechanical in a sense, which is basically you have rules, and the regulators have to check that those rules, those requirements are satisfied. With the use of internal models and all kinds of complicated things, under Basel II, you allow banks and insurance companies actually to have a much better measurement of risks, but this is private information, by and large. I mean, there's some validation of the models and so on, but you have made all those things really private information. And there is this trade-off. Some people say, let's go back to Basel I, even so they know that Basel I is no good. Some people say, let's improve Basel II. I don't know where it's leading. And you know, last thing is, it's wonderful for researchers. We have to work hard. We have to roll up our sleeves. I think we have a responsibility here. This is a disaster. This crisis is a real disaster. And we have a responsibility into improving regulation and basically lobbying for a better management of public policy. And here I'm going to stop, and I want to thank you very much. Thank you.